Welcome to Dark News.
Dark News.
Dark News. Oh, shit.
They'll never know what it means to have a private moment to themselves.
BBC posted their first article about Silk Road and Tor. Oh, I don't have to go to the street corner and get shot?
I think Bitcoin means 1,000 Silk Roads.
This is a show about cryptocurrencies,
anonymity,
and uncensorship.
All right, so we are live for Dark News. Today is May 15th, 2014. Normally we do the show Tuesdays at 3 p.m. every week. That's 3 p.m. Eastern Time and 12 noon Pacific Time. But I was out of town on this week on Tuesday. It's actually doing the Glenn Beck show, so I'll just show you a quick screen cap of that. Here is me, and I was joined by Jeffrey Tucker and Elizabeth Ploshay on Glenn's show, and I must say that it was a very enjoyable experience. I was very surprised and pleased with Glenn Beck's openness to Bitcoin. He was very humble about the limitations of his knowledge, but he seemed very excited about the possibilities, and I thought it was a very positive opportunity to educate Glenn and of course his audience about the cryptocurrency. So that was a good deal of fun. And for those who may have started following my work recently through the Glenn Beck show, I mentioned on the show 2 books that you should know about. One is Anonymous Bitcoin, and that's the book that I wrote a couple months ago and have been updating every once in a while, and you can find that for purchase at anonymousbitcoinbook.com. The foreword of the book was in fact written by Jeffrey Tucker. He wrote a nice little foreword for the book, and I'm also working on a new book. Just going to be a shorter book, a less serious book, but just a book for beginners who are looking to understand, they want to buy some Bitcoins, but they know that they need to do something to secure those Bitcoins. They're not really sure where to start. So this book is supposed to be for them. You can find some more information about that at securebitcoinbook.com. And in fact, as soon as the book is available for sale, if you provide your email address at securebitcoinbook.com, then you'll get an email notifying you about the book being available for sale. Now, of course, this show is listener funded, so if you are enjoying the show, if you want to show your support for the show, please do consider doing so. You can send various cryptocurrency tips. I think I added a Darkcoin tipping option last week, in fact, so I'd be very happy to receive some Darkcoins. We'll talk about Darkcoin a little bit more later in the broadcast. And there's also a Patreon website where you can kind of do a monthly subscription if you want to go about it that way as well. And if you have any questions that you'd like to have answered today, I'm still receiving questions from folks. So the best way to do it is you can go on Twitter. You can send a tweet to @DarkNewsShow on Twitter, or you can use #DarkNews. And that will show up on my Twitter feed, and I will answer your questions at the end of the show. You can do that at any point of the week. I always, before the show starts, I always go on and check to see what questions we have. And of course, if you are watching through the YouTube apparatus, you can also use the Google Hangout Live Q&A chat function to answer questions as well, and I'll be keeping an eye on that. And we will answer your questions at the end of the show. So that's it for my intro. Let's take a look at the dark market prices for today. So these are the dark market prices for May 15th, and these are all priced in terms of what you can buy with $1. So essentially this is a little bit of a tale for how the dollar is doing relative to all these other cryptocurrencies and commodities that we're tracking. So the dollar gained about 1% with respect to gold and silver in the last week since last Tuesday. Lost about 4% to Bitcoin. So Bitcoin went up about 4%. Darkcoin is the hero of the week. This is one of Darkcoin's, it's either the first or hopefully not the last of Darkcoin's Cinderella moments, and she's wearing her most beautiful black gown and looking quite stunning, I must say. So Darkcoin, it went up quite a bit this week. You can now buy only 0.21 Darkcoins for every US dollar. That's up from 0.6 last Tuesday, which is a pretty stunning 65% decline for the dollar overall in just the last week relative to Darkcoin. And that's about 82% decline since we first started tracking Darkcoin. So a lot of that movement has been in the last week. Darkcoin has also gained a significant market cap ranking in the cryptocurrencies. It's gone up from number 10 to number 7, surpassing such cryptocurrencies as Blackcoin, Namecoin, I believe, is in there, and it's coming for next. So Darkcoin is on a very precipitous and impressive rise right now. Meanwhile, Anoncoin went up about 11% or so relative to the dollar in the last week. Anoncoin aspires to incorporate the zero cash technology into its cryptocurrency when it's ready to be incorporated, and so that should be a very interesting coin when it very fully launches. Still mining Anon coins at the moment and trading Anon coins, and it gained from 36th place to 29th place in the cryptocurrency rankings. That's a 7-place advantage of the last week. Fedora coin has been on a bit of a slide on the other hand. So Bitcoin has lost 46% of its value since we first started tracking it on Dark News. Meanwhile, Fedora coin has lost 70% of its value to the dollar. That's 34% just in the last week. It's continued to slide in the market cap rankings from 65th place last week to 78th. And so very curious to see if that trend continues. And for the ammo prices that we've been tracking, not much of a change in the last week. And of course, finally, for the gold, silver, Bitcoin, Darkcoin, and Anoncoin market cap, about a 1% decline relative to the dollar in the last week. That's almost entirely still gold and silver. And that market cap, just to sort of recap that, people that may be joining the show more recently, that market cap is based on gold and silver. We take the current value of gold and silver on the markets, and we multiply that by the above ground available amounts of these precious metals of actual bullion. We're not looking at paper contracts because I think paper contracts are a bunch of nonsense, and they will see a substantial decline. We'll see the price much more based on actual metals in the future. So if we take a look at the cryptocurrency graphs overall, this is just in the last month, so since about April 16th. We can see that up until April 22nd, everything was tracking about the same, following along with Bitcoin. Bitcoin is this blue line, red is Darkcoin, Anoncoin is the a yellow or orange line, and the green line is Fedora coin. And I've changed all of the units of currency to sort of so they fall around the same range of numbers. So we use millibits instead of bitcoins and megatips instead of Fedora coins. And you can see that Darkcoin has just taken off like crazy. Had this huge boost between April 22nd and the 26th, then a little bit of a retracement, and then again in the last several days, it's just taken off again like a rocket. So very impressed with the market action with Darkcoin right now. I'm seeing a lot of people talking about Darkcoin. A little bit of news related to Darkcoin. Darkcoin has been putting out a couple new versions of the software recently, which is, of course, what is driving a lot of the interest in the price. And, if you are using a Darkcoin, if you're running one of the nodes or master nodes, do make sure that you have updated your software. Apparently, if you didn't get up to like the last version or the one before that by the 14th, then you got forked, and you won't be able to do what you want to at that point. So make sure that you are up to date with your Darkcoin's software. Now, this is very exciting to me. This is a very exciting topic for me. Talk about blind mixing and ring signatures. So blind mixing is this term that as far as I know, I invented it. Maybe someone else has also independently invented it. But to me, it's a way of it's a mixing technology where people are able to mix their coins together, but none of the participants need to know any of the relationship between the starting address and the ending address. The idea is you're going to have some Bitcoins or some dark coins or some whatever at a starting address. You'll go through a mixing process, and then it will end up at some destination address. And the purpose of mixing is so that no one knows the relationship between those two. But a lot of the mixing technologies that have been deployed in the last few years have relied on some trusted third party knowing that relationship. This is still the case for Darkcoin right now. They have these master nodes that are capable of orchestrating the DarkSend operations. And at the moment, they do need to know that relationship between the initial address and the destination address. But Darkcoin just recently announced that in the next version of DarkSend, version 2, they will be deploying. So this is from May 12th, so just a few days ago. So I think this is relatively new news, but they will be implementing a new technology called ring signatures. So let's talk about ring signatures. Now, I know that pretty much everyone in the audience that's watching right now is, a cryptographer with many years of experience. They probably have multiple PhDs in computer science and mathematics. So here's a chart from a paper from Shamir and Rivest and Tallman. And I think this should pretty much explain it. So we'll just go ahead and move on to the next subject. Just kidding. So this is some information that I pulled down from the CryptoNote.org website. So CryptoNote is this technology that builds off of the Bitcoin payment technology. And the purpose of CryptoNote is so that we can do this kind of blind signature, blind mixing kind of stuff. People are able to do some. This is getting a bit away from the idea of mixing coins, but it's the same fundamental idea where people are getting together on the same place and time on the internet, and they are performing transactions in a group of people, and we can't really tell which of the people in that group are performing the transactions. So with mixing, the idea is that you could kind of use this type of technology so that any third party that is sort of helping to orchestrate the mixing doesn't necessarily need to know the relationship between the starting address and the final address. This is starting to get a bit away from the mixing paradigm or metaphor, but it's still fundamentally the same concept. It's this technology based on blind signatures. So CryptoNote has a good little explanation of how this works, and Darkcoin, I think that their implementation of these ring signatures, which we'll explain in a moment, are very much inspired by the work that CryptoNote has been doing quietly over the last couple of years. I did a bit of reading on this CryptoNote stuff, and basically, it came out after Bitcoin. They're taking they're resuscitating some of this work done by people like David Chaum and other cryptographers, R.L. Rivest, A. Shamir, etc. And they're resuscitating it and combining a Bitcoin technology with this kind of blind signature technology to provide more untraceable payments. So let's look at the CryptoNote explanation. So they talk about, first they explain, here's what an ordinary cryptographic signature looks like. We have Alice, who's going to be some cryptocurrency user, and she's going to have a private key and a public key. The private key is the secret that allows Alice to spend her Bitcoins or her Bytecoins or her dark coins or whatever it is, and no one else has access to that private key, and so no one else can spend her coins. And the way that she is able to have her transactions verified that is by putting out there into the public a public key that people can use to verify her ownership of these coins. So it's using this private key, a public key pairing, and the ability to sign messages with your private key that only you have. So when you sign something with your private key, people can verify that it was signed with your private key by performing a very similar correlative operation with your public key, and they can verify that no one who does not have access to your private key was able to sign that message. It's a way of establishing authenticity. So this ring signature idea is sort of extending that. So again, everyone is going to have, so now it's a multi-party type of operation. So we have Alice, Bob, and Carol that are all going to be doing something together. And they all have their own private key and they all have their own public key. And they will share amongst each other their public key and keep to themselves their private key. And so the website says ring signature is a more sophisticated scheme that demands several different public keys for verification. For a ring signature, we have a group of individuals, each with their own secret and public key. The statement proved by ring signatures is that the signer of a given message is a member of the group. The main distinction with the ordinary digital signature schemes is that the signer needs a single secret key, but a verifier cannot establish the exact identity of the signer. Therefore, if you encounter a ring signature with the public keys of Alice, Bob, and Carol, you can only claim that one of these individuals was a signer, but you can't pinpoint it to one specific individual. So the idea is that you have this group of people, they're able to sign something all together, that you know all of their public keys, and you're able to tell that at least one of them signed off on this message, but you can't tell exactly which one it is. And so obviously this is a way of doing something related to this, using the signature to prove your ownership of a cryptocurrency without necessarily being able to tie it to an identity. So let's just take a little bit closer look at this. So it says this concept can be used to make digital transactions sent to the network untraceable by using the public key of other members in the ring signature, and only one of them will apply to the transaction. The approach proves that the creator of the transaction is eligible to spend the amount specified in the transaction, but his identity will be indistinguishable from the users whose public keys he used in his ring signatures. So in this little diagram here, we have Alice, Bob, Carol, and Dave, and it appears that they're all part of the same ring group, or whatever you want to call it, and they're doing some sending of coins. And then we have Romulus and Remus, and Romulus and Remus are trying to determine, which this coin that I got, where did it come from? Did it come from one of these three parties, or did it come one of these parties? And they can't tell because the ring signature is in place. So this is a very, very clever scheme that allows you to basically hide your identity while still being able to prove that you are the rightful owner of the cryptocurrency, sending coins around to other parties while remaining anonymous within the particular group of people. So you still want this group of people to be fairly sizable, and across multiple transactions, you could, so let's say you had 8 people in the first group, and then you did another transaction with another 8 people. Now, if you just stay with the same 8 people, obviously your anonymity is limited to being distinguished between yourself and the other 7 people in the group. If you use a new 8 people each time, then it does mix it up quite a bit more. So this is a very clever and interesting approach to achieving better financial privacy. So there are already a few different cryptocurrencies that have applied this CryptoNote technology, and they've been around for a while. They don't seem to, I haven't been able to find them on any exchanges yet. I'll take a closer look at this maybe for next week. But really the main story here is that DarkSend, this technology has come on the radar for the Darkcoin developers, and They are planning to integrate it into their technology into the near future. So that is very, very exciting, and I think probably helping to fuel part of the rise in price. So let's look at the next story. This is about, I just briefly wanted to touch on this. This is another story coming out of the Snowden leaks in the last few days. And what Glenn Greenwald is reporting, published on Tuesday by The Guardian, apparently the NSA has been adding backdoors into US-made networking routers. So the military calls this supply chain interdiction. And apparently some equipment that's been shipped overseas to places outside of the United States adds in a kind of phone home surveillance capability. So according to the article, the NSA has routinely intercepted networking equipment that's built in the United States, added backdoor access capabilities, and then shipped the devices to their intended recipients abroad. And this is coming out of the NSA's Access and Target Development Group. I'm not sure how that might be related to the Tailored Access Operations Group, or TAO. So the NSA routinely receives or intercepts routers, servers, and other computer networking devices being exported, and then bugs them. When the hacked networking equipment is brought online, it phones home to NSA-controlled servers. In one recent case, after several months, a beacon implanted through supply chain interdiction called back to the NSA covert infrastructure, according to Greenwald. And that callback allowed the NSA to access the device further and exploit it further and survey the network that this device was attached to. So not too much more to say about that article, aside that, you know, the NSA is doing a bunch of stuff that we sort of suspected that they were already doing. And this only talks about the interception of devices that are heading out of the United States, but of course, I think we should also be very suspicious that it might be happening within the United States as well. NSA is generally not supposed to do that type of thing, but of course I suspect that they will do pretty much whatever they want to do. Now this next article I think is very interesting on the topic of money laundering. So a criticism that has come up around Dark Wallet and Darkcoin and other mixing services that have been around for a while is that somehow they're going to lead to money laundering by criminals. Well, this article by Paul Craig Roberts from the Institute for Political Economy talks about money laundering, but it's not from the more socially acceptable suspects that we might point the finger to. So the article reads, is the Fed tapering? Did the Fed really cut its bond purchases during the 3-month period during November 2013 through January 2014? Apparently not, if foreign holders of treasuries are unloading them. From November 2013 through January, Belgium, which has the GDP of $480 billion, purchased $141.2 billion of US Treasury bonds. Somehow, Belgium came up with enough money to allocate during a 3-month period 29% of its annual GDP to purchase US Treasury bonds. Now, Belgium did not have a budget surplus of $141 billion. Did it have a trade surplus during that period? No, it didn't have that. In fact, its trade and current accounts are in a deficit. Did their central bank print $141.2 billion worth of euros in order to make it happen? Well, of course not, because Belgium doesn't have that ability. It's part of the euro system. Its central bank can't do that. So where did it come from? And the writer goes on to say there's only one source. The money came from the US Federal Reserve, and the purchase was laundered through Belgium in order to hide the fact that actual Federal Reserve bond purchases during November 2013 through January were $112 billion per month. So basically, they are trying to hide the US purchasing bonds from itself. Why did the Federal Reserve have to purchase so many bonds above the announced amounts? And why did the Fed have to launder and hide the purchase? Some country or countries unknown at this time, for reasons we do not know, dumped $104 billion in treasuries in 1 week. The Fed realized that its policy of quantitative easing, initiated in order to support the balance sheets of banks too big to fail and to lower Treasury's borrowing cost, was putting pressure on the US dollar's value. Tapering was a way of reassuring the holders of dollars all over the world in dollar-denominated financial instruments that the Fed was going to reduce and eventually end the printing of new dollars with which to support financial markets. The image of foreign governments bailing out treasuries could unsettle the markets that the Fed was attempting to soothe by tapering. So, for a long time, the Fed has been doing this kind of cat and mouse game with the dollar, where they pump it up, they try to artificially inflate the value of the dollar by printing a lot of money, and that makes the holders of the US dollar worried because they don't want their investment or their bonds to be completely devalued, and so it makes them nervous. And so the Fed has been saying, oh, well, we're going to do a little bit of QE, a little bit of quantitative easing, a little bit of money printing, and then we'll taper it off. It's just temporary, just to stimulate the economy a little bit, just to give it a little boost in the morning. It's like a 5-hour energy drink. And so basically what this author is accusing the Fed of doing is pretending that fewer people are dumping their bonds, or that their bonds are worth more to other people than they actually are. So what we have is the US buying its own bonds, trying to prop up these bonds. And so not very good times, not looking very good for US bonds right now, I must say. And how amazingly hypocritical for people to accuse these small-time criminals or completely, non-criminal individuals for laundering money when they're just trying to achieve kind of a small-scale financial privacy, when the central bank of the U.S. government is in fact laundering billions of dollars, hundreds of billions of dollars. This is a perfect example of the small crime or big crime concept, where small crimes are incredibly heinous. They are crimes against humanity and need to be punished severely. And massive, huge crimes against humanity are geopolitics and their collateral damage. Now, I wanted to briefly touch on a couple of just short articles underlining the point that you should minimize the amount of cryptocurrency that you're keeping on your online devices. This would include, your cell phone, your tablet, your home computer, your laptop, etc. So both of these articles are by Kelly Jackson Higgins from Dark Reading. And this first one is about smartphone users. So it says 1 in 10 US smartphone users are victims of theft. And a new study finds that 1 in 10 smartphone users have been stolen from, and only about 30% actually get their stolen smartphones back. The greatest number of thefts happen when a smartphone user inadvertently leaves his phone in a public place. That's 44% of the time. Restaurants are the most common places where that occurs, followed by a burglarized car or house, a bar or a nightclub, work, public transportation, and on the street. Some 40% of victims say their smartphones were stolen between lunchtime and the close of business. So this is not something that's done in the dead of night, breaking into your home or whatever. This is mostly just out and about, people leaving their phone in the wrong place, or just being kind of casual about where they keep their phone and having it stolen. So if you keep your cryptocurrency on your phone, then that is not necessarily the best idea. You should basically treat any of these online devices like a cash wallet. You only keep a certain amount of cash on hand, and you should make sure that even when the price rises with these cryptocurrencies, you keep putting all the excess cash that you don't feel safe to have in your wallet into some type of cold storage. Now, this next article is about botnets and the affection of computers. So this says nearly 85% of enterprises, that's businesses, are harboring malware, and a new botnet emerges each day, according to this Checkpoint report. Now, I don't know about the veracity of these numbers. Checkpoint software is trying to sell people security software, so they could be exaggerating the threat, of course. But it does sound plausible to me as someone that has worked in the enterprise space and kind of large scale places for a number of years. I find it quite plausible that at least one computer in a very large percent of organizations is going to be infected with some type of malware. And that can happen for you at work, it can happen at home, it can happen to servers. And so do be careful about what kind of funds you are keeping on any of these computers that are left online. So that will do it for the news for today, and I will take a look at your questions. We have a few questions that people submitted before the show. So the first question was submitted by an anonymous viewer, and he wanted some help in understanding sidechains. So this topic that's been pretty hot in the Bitcoin space recently, and I find that many of the explanations that have come from the sidechain experts, the people that are actually going to potentially write software for sidechains, it tends to be fairly technical. They bring up things like Bloom filters and all kinds of stuff that the average techie person, but not necessarily cryptographer, will not be familiar with. And so I wanted to point to this article. This is posted on CryptoBiz magazine, which is a new Bitcoin news website that looks very promising. And I've recently submitted an article too. This is written by Jacob Payne, and I think that it's a very good way of getting an introduction to exactly what sidechains are. So I'm just going to kind of skim through it. I won't read the entire article, but I think it will be quite helpful in allowing people to understand what the deal is with these sidechains. So he starts off talking about this article that was written by Vitalik Buterin, who is the chief scientist of the Ethereum project, who tried to talk about this topic once or twice before, and he's sort of building off of this article that had been written by Vitalik. And so it starts out by explaining one-way pegging. One-way pegging. So the motivation for one-way pegging apparently was occasionally these forks come up in the Bitcoin blockchain. There's some type of mistake happens and part of the network gets segregated from the rest of the network. We call them hard forks, and they're unintentional hard forks. You can also have hard forks that are intentional, where you want to make some kind of fundamental change to Bitcoin, and everyone needs to update to a newer version of the software. But sometimes it happens inadvertently as well. And so the problem is, during this time where part of the network is segregated from the main part of the network, let's say, they're still doing transactions, they're still doing mining, and at some point they need to catch up and sync up with the rest of the network. But when they do that, is there some way that we can honor their transactions between the two versions of this blockchain? So one-way pegging would be one way of approaching that. And basically we do something like a proof of burn, which is a way of just destroying Bitcoins or some kind of cryptocurrency. And we would say we'd have some kind of, this would be implemented in the software. It'd say, look, if you had some Bitcoins that you mined or received in the less popular fork of the Bitcoin blockchain, we'll call it version 1. So you got some version 1 Bitcoins and you needed to catch up and resync with version 2. You can send your Bitcoins, your version 1 Bitcoins, to an address that you won't have access to. We'll just make it some random Bitcoin address that no one has a private key for. And when you send them, they'll be effectively burned. And when you do this, we will then reward you with version 2 Bitcoins in the regular mainline version of the blockchain. And this is a way of not completely losing everything that you did on the forked off version of the blockchain, but you're not able to try and duplicate this process because you've burned the coins. So that's a one-way pegging, where you can take Bitcoins from one blockchain and move them to the correct blockchain, so to speak. And then we get into two-way pegging, where you could move Bitcoins between blockchains in both directions. So instead of destroying the old coin, the idea is that you could send the old coin to some kind of special address, and you would only release the coins once you get a specific digital signature. Now, it turns out that the digital signature can be a proof of burn, but this time the new coin is sent into the trash address, and the sender of that new coin is then allowed by the network to unlock the old coin from storage. So sidechains are building on this concept of two-way pegging, where you can take some coins in Bitcoin, move them to a sidechain, pegging them one way, and then later on, if you needed to, you could move them back from the sidechain back to the Bitcoin blockchain, because it's pegged in the other direction as well. So what would be the motivation for doing this? Well, first of all, you can sort of the coins that are in the sidechain can kind of borrow from the value of Bitcoin. And so instead of starting from scratch when you have a new altcoin, you can start off by sort of borrowing from the value of Bitcoin by moving them in a one-to-one relationship between the Bitcoin blockchain and the sidechain. But more importantly, we have to talk about mining, right? So in a normal cryptocurrency blockchain, the verification of transactions and the coin mining are combined together. This is something that I was sort of thinking about before I went on the Glenn Beck show. Unfortunately, I didn't have time to get into it. I think we talked a little, just very briefly about this concept, but one of the major achievements that Satoshi had was that he figured out you can incentivize people to validate transactions if you give them some Bitcoins, if they're allowed to mint some new Bitcoins in the process. So for a sidechain, if the value of the coin is pegged to the original crypto coin, then it can only mint a sidechain coin when it is pegged to an already existing crypto coin. So let's just say you have Bitcoin, you have a side coin. A side coin only comes into existence when you peg you set aside your one Bitcoin, and you say, okay, this Bitcoin is now locked down. It's now one side coin. And at some point in the future, if we want to, we can get rid of that side coin and turn it back into a Bitcoin. Now, here's the issue with side coins, with these side chains. If you can only make money in the side chain, if you can only get a side coin when you move a Bitcoin over, if there's no mining of new side coins in that sense, then you've now lost the financial incentive to validate transactions, except for the mining fees. But the issue is that it's going to be very difficult to financially incentivize miners to move over to the sidechain and do their stuff there. Like, let's say the sidechain works on a new hashing algorithm. We'll call it X13 or something like that, right? And so they were mining SHA-256 on Bitcoin. Why would they ever start mining X13? Well, you can offer them these kind of piddling mining fees, but unless the mining fees are going to be astronomical, it's going to be very difficult to incentivize miners to stop mining Bitcoin and move over to this sidechain. So that's a real problem for mining. So one approach to this issue is to do merge mining. And the idea with merge mining, I love this little graphic here. It shows merge mining and an evil miner who's doing a merge attack, and he's got little horns on his mining hat. And so it's easy to do against one of these smaller altcoins, much more difficult to do against Bitcoin. Well, let's read from the article. So in a normal altcoin chain, when an attacker initiates an attack, he is forced to move his hashing power towards the altcoin blockchain and thus losing potential gains from Bitcoin mining during the frame of time of the attack. So in merge mining, basically you're allowing people to simultaneously mine Bitcoin and one of these side chains at the exact same time. So they don't actually have to move any resources over to mining the side chain. They can just say, well, I'll do both, and I'll just get some Bitcoin and I'll get some of the side coin at the same time. So just, it's as long as I'm not spending extra energy, electricity in the process, if the side coin, these fees are worth it to have me do the merge mining, then I may as well go ahead and do that. And this is why you see a lot of people doing Bitcoin and Namecoin at the same time, is because Namecoin is merged mined with Bitcoin. You can do both at the same time with very little downside to doing so. Now this introduces another issue. Now you have provided people much more. So let's say we do this merge mining in a sidechain. You now have given people much more incentive to go ahead and confirm transactions within the sidechain, but it also means that if someone wants to do a 51% attack, it's less costly to them to do so, because they can continue to mine Bitcoin at the same time. So it's a bit of a catch-22, and I think it's a open problem that hasn't been entirely solved yet. I know that Adam Back and some of the other people that are advocating for sidechains feel like they have either resolved this issue or that they will be able to do so in the near future. So we'll see how it pans out. Now, someone did point out to me on Twitter that it seems that enabling the sidechain stuff with Bitcoin would require some significant changes to the Bitcoin protocol. And of course, whenever you make a significant change to the Bitcoin protocol, the danger is that it's going to introduce some new vulnerability or some new instability within the system. And so, some developers don't even want to get into the sidechain stuff because they don't see it as worth the risk of doing this. On the other hand, if you can get sidechains working properly and working well, then it could be very beneficial to Bitcoin. For example, it might get around this sort of transaction time issue that we have with Bitcoin, where if you want to buy something and you want to get it validated or confirmed quickly on the network, you have a problem with Bitcoin. You have to either wait about 10 minutes or more for the transaction to get validated by the miners, or it would have to be confirmed through some kind of off-chain accounting that takes place. Blockchain.info kind of does this. I believe Coinbase as well. Lots of different other services. But this is a centralized approach, fundamentally, to getting transactions validated quickly. And there are, we all know that there are significant problems with centralization. And so it's not an ideal solution. If we can get sidechains going, then maybe we can do quicker transactions on a sidechain that's designed to do faster transactions, and then we might be able to still have a decentralized approach to getting these transactions done quicker. And we don't need an entirely new altcoin that has its own blockchain completely separate from the Bitcoin blockchain, not using any of the mining power of the blockchain and so forth. So there are many potential advantages to getting sidechains working, and we will just have to wait and see how it all plays out. So I hope that is somewhat helpful in understanding this sidechain stuff. So this comes to us from Crypto Biz Magazine, which hosted the sidechain article that we just talked about. And they ask, do you see the dark wallet concept as striking a chord with crypto wallet / coin developers over the next 12 months? So to some degree, it already has. I don't think this is a secret. So I've heard a rumor that Airbits, it's this Bitcoin client that they've been working on some mobile clients for a while. They're trying to get into Android and eventually Apple if they possibly can, the iPhone app store. And they're trying to make a wallet that is very user-friendly. It's got a nice clean interface. You've got kind of a directory of different places that you can buy with for Bitcoin, and the intent is on user-friendliness. But I've heard a rumor that in the background, they're also trying to incorporate some of these privacy features inspired by Dark Wallet and other projects in this space. And so I think that it's fair to say that already we're seeing wallets that are inspired to follow the example of Dark Wallet. I know that Peter Todd for a while has been working on a CoinJoin implementation for the Bitcoin Core wallet. I don't know what the status of that is, but I hope that's something that's going to come around the bend soon. So I think it will eventually become quite popular for wallet software to add this as a feature to different pieces of wallet software. And of course, once one person gets a really clean, well thought out, well tested implementation of these different privacy features like stealth addresses like CoinJoin or CoinSwap or whatever, then it's much easier for the rest of the wallet services to go ahead and follow suit. Now, some of them may not do this. Of course, if you do implement these privacy features, you may make yourself a target for pundits and for regulators and so forth to be demonized for permitting money laundering. But I think that we will see quite a few clients incorporating this. And what's very exciting about this is that, Dark Wallet right now is operating with no changes to the Bitcoin protocol. So even if the Bitcoin protocol does nothing further to add to the privacy of Bitcoin, we'll still have options like Dark Wallet to give us some of that privacy. There still are some semi-centralized or not widely decentralized aspects of the way that Dark Wallet works right now. It's got this obelisk server that kind of orchestrates the CoinJoin operations and does some other stuff to help clients, connect to the rest of the Dark Wallet network. But so it may not be, the final solution for privacy in Bitcoin or cryptocurrencies. But of course, it has lots of competition. Looking at this CryptoNote stuff, there's a bunch of coins that are based on CryptoNote. We've got Darkcoin, which has been just going bananas in terms of its price, and it looks like the main developer Evan is just working his pants off on this technology. Really, really impressive what he's doing with Darkcoin so far. So regardless of what happens with Dark Wallet, I think we'll see more and more of these privacy technologies developed. I saw a little while ago this article that was talking about, I think the name of the article was like, how Darkcoin can help Bitcoin. And what the author was suggesting was a possible scenario in which Bitcoin does not continue to progress in terms of its privacy. Let's set aside the dark wallet people for a moment. Set aside Peter Todd for a moment. But we can still have these alt currencies that are privacy centric. And so if regulators want to demonize or whatever, they can say, well, look, Bitcoin, don't have any of these. It's public. We have a public ledger. We don't have any of these privacy technologies. We've abandoned that. So it's all fine and dandy. And then Darkcoin can be kind of the bad guy and be the coin that you swap into and out of to kind of mix your coins around. So that's another possible scenario. I still think that privacy with Bitcoin is going to plunge forward, but it's interesting to think that even if that didn't happen, there would still be other avenues for cryptocurrency users to obtain privacy, even if it does not happen within the mainline currency or the Bitcoin currency proper. So that is going to do it for Dark News for today. Thanks so much for your questions and thanks for watching the show. I'm glad to be back home and getting back to the show, and I will join you next week on Tuesday at 3 p.m. Eastern Time, 12 noon Pacific Time. And we'll see you then. Have a fantastic week and stay safe out there.